Let's take a view on shorts, the self-interested rascals cynically destroying profits of noble stock market investors everywhere, helped only by the prime brokerage desks of all major investment banks, and the large pension funds and mutual funds which lend shares to these short sellers. These traders appear as if by magic at scenes of financial violence. Invoked whenever a bank is failing, a share price is tumbling, or perhaps a privatization goes badly, the question is often whether the short sellers should be stopped. A more pertinent question, however, for managers of the companies faced with plummeting share prices might be this one. Can they be stopped? Unlike governments, who have imposed intermittent bans on the practice of short selling for more than 300 years, the shorts cannot be wished away by fiat. A standard tactic is to blame the shorters, which also helps to dismiss investor concerns as cooked up by manipulators or perhaps those with an axe to grind. The courts may also be used, although not with a great track record of success, but at least to buy some time. Last year, after the New York-based Gotham City Research published a scathing report about London-listed Quindel, the company secured a default, and so perhaps unenforceable, libel judgment in the local courts. This week, the Serious Fraud Office in the UK announced an investigation into the company's accounting practices, perhaps vindicating some of Gotham City's work. A more direct way to make life difficult for the shorts is with cash. Singapore-listed Noble Group, for instance, an embattled commodity trading outfit. As you can see from the chart, its share price has been under pressure somewhat, although it has been buying back its own stock. It had to stop this as it approached its results under Hong Kong rules. As you can see here, the shares then came under increased pressure. Noble responded by bringing forward the date of its results to address criticism of its accounting. Noble then disclosed an approach by an unnamed strategic investor and made a statement of financial strength. This caused the stock to bounce by more than a quarter in a day and frankly sent the short sellers running for cover. Then in Australia, something else unusual happened this week. This is the share price for Slater and Gordon, which bought much of the business of Quindel earlier this year. As you can see, short interest has been rising this year. After the announcement of a criminal investigation on Wednesday into Quindel, alongside the publication of some heavily restated accounts, attention turned to Slater and Gordon in Australia. The question remains, what is the value of the business it has bought? Now look at the one-day share price chart. As you can see here, the stock dropped by almost a fifth at the start of trading. But then something happened. It rebounded. According to dealers, large investors in the company had suddenly removed their stock from the pool available to the borrow. This left shorters at risk of a so-called squeeze. This happens where shorters rush to buy stock in order to cover their short positions. Suddenly, the share price has, at least for now, recovered. At both Noble and Slater and Gordon, the shorters appear to have been foiled for the present. Both will soon present results, which will be an opportunity for the only surefire way to stop the rascals, however. Transparently answer their questions.